welcome to Market Domination. I'm Julie Hyman. Josh Lipton is back live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline Blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We're looking for 0.3% on a month-over-month basis, specifically for core CPI. We're only looking for inflation to be 2.2% this year. We look for inflation to slow even further next year. So we actually think the Fed's going to be in position to start cutting here in June.
You have a Federal Reserve that clearly wants to cut rates. Let's be honest. The Fed is dominated by doves. It is not dominated by inflation-fighting hawks. The Fed is fighting the economy. In particular, they're fighting the American consumer. And that's a fight that I would not want to get involved in.
Google will essentially be competing with Intel to a degree by putting out its own CPU, basically kind of touting this energy efficiency and performance gain for their applications. And they say they're already using it in some of their own applications. They're using it for things like YouTube ads, BigQuery, Blog Store, Google Earth Engine. And so those are now running on these CPU chips that Google is building on their own.
We've got an hour to go until the market close. Let's take a look at the major averages and how we got here. What's interesting with the Dow today, we opened up higher actually and then headed lower. There wasn't any necessarily specific catalyst here. A lot of chatter around the CPI report that we'll be getting tomorrow morning and what that is going to mean for the inflation outlook and, of course, by extension, the Federal Reserve. We are seeing the Dow now down by nearly 200 points, about 0.5%. The S&P 500 off about 0.4%, and the Nasdaq is off about 1/3%. And, you know, we've been talking recently about how that we've seen Treasury yields creep up and that has been a little bit problematic for stocks, but yields are down today and stocks are still down. So obviously removing that obstacle did not help things. Take a look at what's going on with the sector action as well today. What we have here is financials falling the most. And remember, we're going to start to really get those earnings in earnest on Friday. In fact, our playbook today will tell you how to trade those big banks going into the earnings. Industrials also down today. You got real estate and utilities up, so kind of a flip of what we've been seeing as of late. Defensives leading the gains and cyclicals down the most. And then just quickly want to take a look at the Nasdaq biggies here, the Nasdaq 100. We've got NVIDIA, which is down 3% today. That's definitely not helping matters. Meta also a drag on the major averages. And Josh is watching one of today's top trending tickers.
That's right, Julie. Let's take a look at Boeing right now because it's making headlines. And it isn't good. The New York Times reporting that the FAA is investigating claims made by a Boeing engineer who was making some alarming statements here, saying sections of the fuselage of the 787 Dreamliner are improperly fastened together and could in fact break apart mid-flight after thousands of trips. The engineer apparently detailing these allegations in interviews with the Times and in documents sent to the FAA. We should note Boeing is responding here. They are disputing this. We reached out to the company. Here's what they told Yahoo Finance. Quote, these claims about the structural integrity of the 787, they say, are inaccurate and do not represent the comprehensive work Boeing has done to ensure the quality and long-term safety of the aircraft. So they're disputing this, Julie, but the stock is down today, and you're down now about 30% so far this year.
Yeah, and this is just one more piece of bad news for the company and sort of incremental evidence about what was potentially going on and has been going on at Boeing. Sam Salahpour is the name of the whistleblower in this particular case, and he's actually set to testify on April 17th before a Senate committee that's been examining all of this. Among Salahpour's other assertions and allegations here is that he tried to escalate some of his concerns to management, and he was retaliated against. And that's part of Boeing's response as well. They said in their statement to us, retaliation is strictly prohibited at Boeing. But once again, this paints a picture of lack of quality control going on at the company. By the way, Boeing also reporting its deliveries in the first quarter today and said that they were the lowest since mid-2021. 29 aircraft in March, which is up from 27 in the first couple of months of the year. Not a surprise here necessarily, but still sort of drip of this news.
Yeah, it's interesting. We have had investors come on the show. I mean, not many, but we have heard some come and pound the table for Boeing. And what they'll kind of say is, well, long term, at least part of their thesis, Julie, will be it's still just Boeing and Airbus. It's still a duopoly. But these headlines, at least in the near to intermediate term, these headlines keep dropping. Obviously, big changes in the C-suite. The DOJ's involved. So lots of moving pieces. We move on. Big tech making big news this week at its annual cloud computing conference in Las Vegas. Google introducing a new chip called Axion, a custom-built ARM-based server chip. And meanwhile, Intel debuting a new AI chip called Gaudi 3, designed to take on NVIDIA's most popular AI processors. Here to help us break down what this all means for investors, exactly the man we need to talk to, Patrick Moorhead, founder and CEO of More Insights and Strategy. Patrick, it is great to have you on the show. Let's start with Google here, Patrick, and this new chip called Axion. Just high level, Patrick, walk our viewers just through this chip. What are the tasks this processor is best suited for?
Yeah, so this new Axion processor is a general purpose CPU, meaning it should be able to do a wide variety of tasks from databases to even light AI processing to web serving and everything in between. It really is the workhorse of the data center. Even with all of this, AI conversation, which is important, you still need a very capable CPU to get the job done.
And how quickly can the CPU get up and running? And what are the implications then for chip companies, for other chip designers, and for Google's supply chain?
Yeah, Google disclosed that they're already using this new chip for some internal workloads, and then for enterprises through Google Cloud will be available later on in the year. And this really is just another proof point of cloud providers like Google Cloud, Amazon, as well as Microsoft, who are doing their own chips. And this does pose a threat for the Intels and the AMDs of the world, but I do believe that the market is big enough for all of them. Now, every one of these custom ARM-based processors that gets sold is one less chip that AMD and Intel can sell. So there will be a mark left. It's just inconclusive of how big that will be.
And Patrick, kind of a broader question to you also, because there are some investors who've been skeptical, Patrick, about Google's AI efforts and strategy. Are you skeptical, Patrick, or no? Do you believe that Google is well positioned in this new era of AI?
Google has a lot to prove. I don't think anybody's questioning the company's technical competency. In fact, they wrote the groundbreaking research paper on generative AI. And I think what people are questioning is, can they extend what they do in consumer, let's say search, to the generative AI world? And then I think even more difficult, extending it to the commercial market, which is what the conference I'm at right now it is all about. And they've had some stumbles. I mean, every major announcement that they've made has come with some baggage. And I'd like to see the company have one major announcement where there wasn't a major issue until I can get confidence that the company can do this. I think the good news is that Google Search is a stalwart here. YouTube and its ad business based around all of those businesses is strong, but they need a major win without any issues to really put their future in concrete.
Well, Patrick, speaking of a needed major win, let's switch gears and talk about Intel for a minute here. Sorry. So the company came out with a new AI chip today, and it says it is faster to do some tasks than the chips on the market from NVIDIA. Does that mean that people are going to buy these chips instead of NVIDIA's chips?
So some people will buy these chips, and I think that Intel will sell billions of dollars worth of these chips. But fundamentally, it's a different architecture from what, let's say, NVIDIA and AMD are doing. On one hand, you have these accelerators, which are a little harder to program, but are much more efficient versus GPUs that are a little harder to program, that are less efficient, but easier to program. And I think what Intel needs to do to fulfill their full destiny is a product that comes out next year, which is a GPU-based accelerator called Falcon Shores. I do believe when that does come out, Intel will have a very provocative opportunity, not only for enterprises, but for hyperscalers, because they'll have CPUs, GPUs, and accelerators across the data center and PCs, which I think will make them much more competitive.
And Patrick, on this new AI chip, the Gaudi 3, do we know how much that's going to cost? Did Pat Gelsinger give us a line of sight there?
It didn't bring costs out, but what they're doing is they are pricing it from a TCO point of view versus NVIDIA. It will be less, right, than the amount, but you might need more accelerators than you need GPUs. One thing I did like is that they didn't just talk about the chip and the card. They talked about an entire platform that they're putting together where developers can come and run their applications on an Intel cloud-based solution. And that was one of the missing pieces that I think is finally coming together. And we've seen a lot of interest for NVIDIA competitors like Grok because they stood up their own cloud where developers could come in and run their workloads.
Patrick, thank you so much. Appreciate it. Good to see you.
Thank you. You too.
We're just getting started here on market domination. Coming up, sticky inflation and strong jobs data has complicated the Fed's next move. Atlanta Fed President Raphael Bostic will discuss the outlook in an exclusive interview with Yahoo Finance's Jennifer Schonberger. That's on the other side. Stick around, much more market domination still to come.
Welcome back to Yahoo Finance. I'm Jennifer Schonberger. Investors only pricing in around 2 rate cuts this year on the back of stronger than expected economic data. That's down from the median of 3 cuts that Fed officials have penciled in. My next guest, though, only expects 1 rate cut this year, and he doesn't expect it until the 4th quarter. Joining me now in an exclusive interview is Atlanta Fed President Raphael Bostic. President Bostic, welcome back to the program. It's so great to have you.
Thank you. It's really good to see you as well, Jennifer.
Great to see you as well, President Bostic. This economic data continues to come in strong. None other than that jobs report on Friday for the month of March. The Fed already lifting its outlook for growth this year. What is the prospect that we could see the outlook for growth upgraded again?
Well, I think it's always possible, but let me just start by saying, look, the U.S. economy has been incredibly resilient, and it's been strong, for the better part of 8 or 9 months. My outlook a year ago was that the economy would be slowing down and would not be performing at the level that it is, and that inflation would be coming down gradually, but not nearly as strong as it has. So right now, I'm actually very grateful that the economy is producing a lot of jobs, that output is up, that wages are up. These are all good things and bode well for the economy. Moving forward, my outlook is still that the economy will slow, but not nearly as much as I had anticipated, say, in January. And we'll just have to see how it goes. But for now, this is all very good news.
How are you viewing the job market now, especially in light of that stronger than expected jobs report on Friday, particularly wage growth? Do you think this economy can continue adding jobs at this pace without adding upward pressure to inflation?
Well, we'll have to see how this jobs report looks relative to the next several that happen. As you know, there's volatility in these numbers all the time. And the last report was certainly a surprise to the upside. But there are a couple things that I've been watching as we've been seeing and tracking employment over the last several months. One is which sectors are producing the jobs. And historically, the job growth has been broad-based. But over the last 6 to 8 months, a disproportionate amount of job growth has happened in the governmental sector and in the healthcare sector. And these are 2 sectors that through the pandemic have been lagging their long-term average. So there is some catch-up that's happening. But I also have to acknowledge that the last couple of reports have been pretty broad-based in terms of growth. And we've been trying to figure out exactly what that means. I think one of the things that we have looked to is a robust response on the supply side. Workers are coming back into the economy, as well as a lot of the supply chains. They've kind of totally opened up, and they're able to function in ways that allow the response to the elevated demand to be quite strong.
Tomorrow, we're going to get CPI for the month of March. Expectations are for 3.7% on core year over year, 0.3% increase month over month. Looking at that year over year, that'd be down about 0.1% from 3.8 in February and down from about 3.9 in both January and December. If that number were to come in line with expectations, how would you view that? Would it give you any encouragement that some of the hotter inflation prints that we saw in the first couple months of this year were due more to seasonality?
Well, look, a number coming in where the financial participants expect would be a welcome development. It would suggest that inflation is continuing to move closer to our target, and that's a good thing. I'll say for me, my outlook has always been that through this year, we would see some bumpiness in the trajectory of inflation. Certainly, my outlook has us moving closer to 2%, but not necessarily in a particularly fast way. So the numbers coming in, as you suggest they might tomorrow, would be welcome. But it just says that we got to keep watching and make sure that pathway continues, because there is some evidence to suggest in the first 2 months of this year that perhaps inflation's trajectory was stalling out a bit and wasn't moving as clearly to that 2% target. So a return to the more clear evidence of that would be a good thing. To me, I think it would still, though, be consistent with my outlook, which says that inflation is only going to come down at a very slow pace through the course of this year.
To your point, you look at housing inflation, that's been slow to come down. We've seen evidence of that in CPI particularly. And Inventory for housing is quite low. That's not expected to change anytime soon. At the same time, we're discussing how strong the job market is. I wonder about services inflation. What is the risk that inflation could stall here or even reverse course?
Well, something that we're watching very closely, as you know, goods inflation has come down very fast and is basically at pre-pandemic levels, but it's on the services side that we've seen the struggles in terms of inflation persistently being higher than it usually is. Now, some of that is because, salaries don't adjust on a month-to-month basis, but rather year over year. But some of it is that, demand for a lot of services is still quite high. We're just going to have to monitor this moving forward. What I would say is that when I talk to my business contacts through the southeastern United States, what they're telling me is a story that gives me some confidence. One is that demand is starting to slow, is not slowing rapidly, but it is moving in the right direction and one that's consistent with what I would expect if we're going to get to that 2% target over time. A second is that they're pretty confident that they're going to be able to retain their labor force and they're not looking to lay off a lot of people, and that's quite positive as well. But the third thing that is quite important and relevant in this context is that most of them are feeling like they have less pricing power than they had, say, a year ago or 18 months ago. Their ability to pass through price increases, they tell me, is much weaker than it was before. And I think that is going to put some constraint on the degree to which inflation can start to move in that other direction. Now, of course, that's what they've told me the last 3 or 4 months. I've got to make sure that that's what they continue to tell me as the next few months happen and we move into the summer where people start going on vacations and taking their trips. It'll be an important time and an important data point to keep track of.
To your point, President Bostic, I mean, you've only penciled in, just mentioned, given the strength of the job market, what is the prospect of not cutting rates at all this year? How realistic of a scenario is that things get pushed back into 2025?
Well, I actually think that the risks are somewhat balanced relative to where my outlook is. So that would say that the economy could accelerate in ways that mean that we have an ability to be more patient even than we are right now, or the economy could slow. I keep trying to remind myself that over the last 6 months of 2023, inflation moved far more robustly than I expected. And that possibility is still out there. And if that pace of decline resumes, it could be the case that I will view pulling forward my inflation outlook and my policy outlook so that we're cutting rates sooner may come to pass. Ultimately, it will just depend on what the data show, but I do think the risks are balanced. And given that the U.S. economy has been so robust and so strong and so resilient, I can't take off the possibility that the rate cuts may even have to move further out.
If you do pull forward your forecast, would that mean that you could see more than one rate cut on the table this year?
It's possible. Look, in the last SCP, our dot plot submission, I had 2 cuts for this year because I had taken on board the rapid decline of inflation through that last 6 months of 2023. What happened for me is that it slowed down and the pace went back to the pace that I had expected initially, which had me at 1 cut. So, I'm open to whatever the data tell us, however the economy evolves, that will govern and guide what I think the appropriate path or policy is. And at this point, I think it's 1, but as months pass, I may move to 2, or I might move to 0, and we'll just have to see where the chips fall.
You mentioned earlier in the interview that if CPI were to come in with expectations, that would be welcome. How many more prints of CPI, PCE moving in that direction would you need to see to become fully confident that inflation is moving back to begin initiating those rate cuts?
So that's a really hard question to answer. I mean, on some level, it depends on the degree to which the numbers come in on point. Do they come stronger than expected or weaker than expected? And so it's really hard to know. What I would say, though, is that in addition to the top line number, I'm actually looking at a number of other things as well. So as you know, the top line number is sort of the average or aggregate of the changes in prices of all the goods in the basket. But what our team does in Atlanta is we also break it down and say, okay, if you go item by item in the basket, what share of the basket is showing price increases greater than 3% or price increases greater than 5%? Because if you have a lot of goods at 5%, it's hard to get to 2%. And what we're seeing right now is that the distribution, if you look at the distribution of price increases, there are far many at the 5% level or higher than what we typically see in a normal time. And as long as that distribution is showing that latent price pressure, we're going to have to be mindful of that and pay attention. So I'm looking at a number of other things, and I'll really want the totality of those measures to be telling me that we're getting back to a normalized level where 2% is likely to happen.
Really quick before I let you go, President Bostic, on the other side of your mandate, the unemployment side, how high would unemployment need to go up, assuming that inflation is kind of at these levels, maybe a little bit lower, but not at your 2% target, for you to cut rates? Is there a certain level that the unemployment rate would need to rise to?
So, I don't have a certain level in mind on this. What I'm really trying to make sure is that we get to our 2% target with as little damage on the employment side as possible. And right now, I'm not hearing from businesses that they're expecting very much damage, if any at all. And that's quite comforting. If I started to get different signals to suggest that there's a lot of coming pain in the labor market side, then I'd be open to changing our policy stance and perhaps cutting sooner. But it's hard to know exactly what number I would need to see. It would really be about sort of what I'm hearing and how I'm hearing business leaders across sectors and our geography feel about the labor market. And if it seems like there's a looming cliff that's coming, I'll definitely have to take that on board in thinking about when it is going to be appropriate to reduce rates.
President Bostic, thank you so much for your insight. I so appreciate it. Let's not wait so long again to have you back.
I'll be looking for the invitation. It's been great to talk with you.
Thanks so much. That's Raphael Bostic, president of the Atlanta Federal Reserve. Julie, I'll send it back to you in New York.
Jen, great job. Thank you so much for bringing us that interview. Interesting stuff there from Raphael Bostic. He sort of made headlines recently for emphasizing that maybe he wasn't looking for a cut until the fourth quarter. But when pressed by our Jennifer Schomburger about whether maybe we couldn't see any cuts this year, he said, well, maybe we couldn't, but maybe we could see more. In other words, he talked about the risks being balanced between growth being weaker or stronger than had been anticipated.
Yeah, he kind of said about the economy. Basically, listen, the economy is resilient. He told us producing a lot of jobs, wages are up. These are all good things. Still predicts the economy is going to slow, but not as much as maybe as he had initially anticipated. On the job market, seeing broad-based growth, he noted. CPI tomorrow, that's obviously on deck, top of mind for investors. His views on inflation, so we might not get back to 2% fast. There's some evidence, of course, earlier this year, perhaps inflation trajectory was kind of stalling. So return to more clear evidence would be good. He said, expects inflation comes down slowly this year.
Well, and I liked how Jen tried to pin him down on, okay, what does that evidence look like? How many CPI reports do you need? How much is the good evidence that the good data, right, that Jay Powell has referred to as the Fed needing before it can move on rates? And he said, well, it's complicated. It's tough to do. I can't give you sort of an answer, a formula, if you will. We just need more good data. I think if I could summarize. Yes.
We were talking about it off camera too. How interesting is, Julie, about kind of just the opinions out there, the varied opinions from smart people whose job, is to look at this data. Because you think of Bostic now saying, okay, listen, one cut, and it's not going to come till Q4.
Right.
We heard Neil Kashkari saying maybe no cuts if the data doesn't cooperate. You heard Jim Bullard saying 3 cuts this year, still base case. I mean, it's just interesting how varied it is out there.
Yes, most definitely.
All right, coming up, we're covering CPI expectations with Dr. Ed Yardeni. That's coming up next on Market Domination.
ultimately, it will just depend on what the data show. But I do think the risks are balanced. And given that the U.S. economy has been so robust and so strong and so resilient, it can't take off the possibility that the rate cuts may even have to move further out.
That was Federal Reserve Bank of Atlanta President Raphael Bostic moments ago saying he wouldn't write off no rate cuts in 2024. For more on the Fed and tomorrow's CPI print, let's welcome in Ed Yardeni, the president of Yardeni Research. Dr. Ed, it's always good to have you on the show. So you heard Raphael Bostic just moments ago. Sounds like his base case still, one cut in Q4, Dr. Ed, but he didn't rule out the possibility of pushing out those cuts. What was your reaction to that? What'd you make of it?
Not really surprising. He's been fairly vocal over the past couple of weeks about his view that the Fed should be in no rush to lower interest rates. And he's been sort of on the more hawkish side, basically implying that we're not going to see much more than one or two rate cuts this year.
And we were talking in our morning meeting today about how much to weight this individual Fed speak. If at the end of the day they all say their different opinions, and then they get in the room with Jay Powell, and he sort of whips them into shape, and they agree. So how much should we pay attention to all of this?
Well, I think the party line, if I can express it that way, has actually been fairly consistent in the so-called summary of economic projections that comes out quarterly following the FOMC minutes. So we had the one in December that said 3 cuts this year. We had the one in March that said 3 cuts this year. So they've been actually, from that standpoint, fairly consistent in concluding that there will be rate cuts this year, but only 3, whereas the market at the beginning of the year was discounting 6 to 7. I think the market now is in line with the SEP, the Summary of Economic Projections, showing the median forecast of the committee members at 3 cuts. But I think Bostic is a bit more hawkish and maybe actually more balanced, saying, look, it's possible that we won't be cutting at all, or we will be cutting only once, but much will depend on inflation. He admitted that when inflation was heating up, it was heating up faster than he expected, and he's somewhat concerned about that possibility.
And Ed, what's your base case? How many cuts are you expecting this year? When do you think they will start cutting it? And does the market need cuts, Ed, to move higher?
The short answer for the last question is no. I think if we don't get rate cuts, it'll be because the economy is doing quite well, in which case the earnings story will be pretty good. I think that would actually be a better scenario for the stock market, because we've seen this straight up move in the stock market, basically driven by the valuation multiple. The PE for the S&P 500 is up to 21, which is pretty rich. I'd much rather see the market moving ahead here on earnings. And I think that's exactly what it's likely to do. So it probably means that the melt-up phase led by the PE might be behind us, and we may have a more gradual increase based on earnings. At least that's my expectations and hope. I don't want to really see a 1999 melt-up in the market. And at the same time, I don't want to see that the market is terribly disappointed by the Fed not delivering rate cuts, but I don't think it will be.
Ed, we had an interesting chat yesterday with Jay Hatfield of Infrastructure Capital Advisors, and he's looking at year-end for the S&P 500 at 5750. For some of the reasons you describe, including being optimistic on earnings, I believe you're still looking at maybe 6 for the end of next year. But does a 5750 handle for the S&P, does that sound reasonable to you, given what you're just talking about?
Well, it's kind of like a card game, and I guess he beat me here. I've been talking about 5,400 by year end, and I've been saying that for over a year. And a year ago, that seemed delusional, but now people are jumping over that 5,400. No, I'm going to stay with 5,400. Again, I think the valuation multiple is rich, and I think we need to see the market being led up by earnings. If that's the case, I think 5,400 still makes sense. I think the market discounted a heck of a lot of good news up ahead here. And I think it's being delivered, but it's not going to be perfectly good.
What's the one big risk to the market, Ed? When clients ask you that, what do you tell them?
Well, it's the geopolitical risk, and the way that impacts the market is the price of oil. Just a couple of days ago, we saw the price of Brent get up over $90, then to $91. and now it's backed off. It went up to 91 before the weekend. I guess people were worrying that Iran would retaliate against Israel, taking out some of their military people in Syria. It didn't happen over the weekend, so the oil market, I should say, has eased off somewhat. But I'd be watching the price of oil for the impact of geopolitical crisis in the Middle East getting worse. And if we see the price of oil stay solidly above 90 and seem to be heading towards 100, I think that could be great for the S&P 500 energy sector, but it could weigh on the rest of the market. Because in that scenario, we're talking about the Fed not cutting because the economy is doing well. If the Fed doesn't cut because inflation is turning out to be more persistent at these levels, then the market would obviously have some trouble with that, because the bond market would have some trouble with that.
Ed, of course, before we get the Federal Reserve cutting, we are likely to get, say, the ECB, maybe the Bank of England cutting rates. Could that then result in a strengthening U.S. dollar? And is that any kind of curb on an increase in the price of oil?
Yeah, I think the dollar is going to continue to be relatively strong here because the Fed really is in absolutely no rush to lower interest rates, whereas the ECB has got a relatively weak economy. They're kind of in a growth recession, whereas we're clearly not anywhere near that. It certainly hasn't been a hard landing, and it doesn't even look like a soft landing. It just looks like the U.S. economy is still flying quite well. So in that scenario, I think the dollar would continue to be fairly firm.
With earnings season on deck, Ed, I'm just curious, which sectors are you overweight here?
Well, I think you have to overweight energy. It's not hard to overweight energy because I think it's something like 4 or 5% of the market cap of the S&P 500. But the reason you have to do it, in my opinion, is that it's a good shock absorber in the event of things continuing to deteriorate in the Middle East. I know we're kind of used to these Middle East crises from time to time that get settled down pretty quickly. This one doesn't look like that's the case, and it looks like it's being viewed as more existential for all sides in the conflict. So it's concerning to say the least. I still like technology, financials, industrials. I think they got the tech are rich in some areas, but I think this is where you got to do some homework. This is where you actually have to do some stock picking based on the fundamentals. It's not not all the tide isn't going to lift all the boats, as they say.
Dr. Ed, always love having you on the show. Thank you so much for joining us.
Thank you.
Time now for today's trending tickers as we approach the end of the trading day. Taking a look at shares of Moderna here. The stock rising after an early study shows positive data on its individualized cancer vaccine. So this was interesting, Julie. In the green, today's trade, team at Jefferies highlighting new data from a combination trial of its experimental vaccine, I guess with Merck's Keytruda in patients with head and neck cancer. At this Indices conference, analyst is Michael Yee, well-known guy, says the new cancer vaccine data is interesting. In his words, says the data suggests the vaccine could potentially work in industries outside of melanoma. He has a buy rating, price targets 125.
Yeah, he says one of the possibilities now is that Moderna would file for accelerated approval for treatment of this particular type of melanoma. There's still another study that's going to be going on. They're enrolling people in a trial right now, but he seems pretty optimistic on it. I thought it was interesting, the team over at Bloomberg Intelligence, you and I spotted this note from Sam Fazeli over there, saying that the excitement over this is actually overdone, that the trial that's being referenced here was quite a small trial and a brief one, so he didn't see it as positive a read-through, but the market is liking it, although in the context of some big declines.
Yeah, I mean, the stock, not good. Basically flat this year, down about 30% in the past 12 months now.
Right, exactly. Let's talk about Blackberry. Those shares are jumping after it announced a collaboration with AMD. And together, the companies are looking to address the need for real-time capabilities and robotics-focused hardware. What does that mean? Well, it means that Blackberry and AMD are going to help to provide some software for robotics in different uses here. We're talking about industrial networking. We're talking about Healthcare, I think some healthcare applications, auto applications, which Blackberry is already pretty active in.
Yeah, it sounds like so basically better robotics capabilities. So to your point, Julie, industrial, healthcare sectors looks like those are going to be the targets, and basically are combining Blackberry software. It sounds like with AMD's hardware. AMD exec quoted as saying the technology takes the future robotics technology well beyond the constraints experienced until now. Blackberry, of course, now known for cybersecurity software. It has been a challenge for that company, that stock. You know, listen, it may get a pop today. It's down about more than 10% this year. It's down about 30% over the past 12 months. Not much love on the street for Blackberry either. Pretty much everybody is on the sidelines, but link yourself to AMD's Lisa Su.
Right.
That's good for a pop.
Yeah, still outstanding is the question of whether BlackBerry is going to split itself into two. It had talked about doing that, cybersecurity on the one hand, Internet of Things on the other, but it hasn't yet moved forward with that.
And finally, check out Norfolk Southern. They're going to pay $600 million to settle lawsuits stemming from that toxic train derailment in Ohio early last year. So they're going to pay the $600 million. This settles the train derailment, spilled all these toxic chemicals. Julie, remember, company saying the settlement resolves all class action claims, emphasizes this is not an admission of liability. Judge, sounds like, does still have to give final approval to the deal. Obviously doesn't, they'll resolve the DOJ suit, accusing the company of violating the Clean Water Act. The state of Ohio has also sued Norfolk, but at least one headline today. You did see shares get a lift on it.
Yeah, and by the way, the company also came out with preliminary earnings alongside the announcement of this settlement. And those earnings looked like they were a little bit below what analysts had been anticipated. Profit 23 cents a share, railway revenue of $3 billion. If you exclude the costs of the settlement, it looks like earnings were $2.26 a share. So, you know, that might be limiting otherwise what might be some gains in the shares. The full earnings, by the way, are due later this month. I'm seeing a preliminary date of about April 24th. The stock, if you look at it, how it's done over the longer term, you know, and how it has done since the accident first happened here, that goes back to February 3rd, 2023, you can see the shares have kind of come full circle back to where they were. They're just about flat over the past year.
And by the way, the company also says to expect as much as $100 million impact on revenue due to port disruptions related to the collapse of the Francis Scott Key Bridge in Baltimore as well.
Okay, good to know. Coming up, first quarter earnings kick off Friday with results from JP Morgan, Citigroup, and Wells Fargo. How should investors position big bank names in their portfolio? We'll tell you next. handful of big banks, JP Morgan, Wells Fargo, Citigroup, they're going to kick off first quarter earnings on Friday. In today's playbook, we're taking a closer look at where investors should focus their attention in the financial sector. Here to discuss, Gerard Cassidy, RBC Capital Managing Director. Gerard, it's great to see you as always. Talk to us about the backdrop for banks right now. I believe we are still seeing sort of slowing growth for many of the banks here. And what does the rate trajectory mean for them?
Thank you, Julie, for having me on the program. And you're right. The trajectory for the banks is, I think, starting to improve because of what you put your finger on, which is the rate trajectory. As you might recall, the forward curve in January of this year, when many of the banks gave guidance for their net interest income, which is essentially their top line revenue, they expected anywhere from 5 to 6 rate cuts. Now the forward curve is calling for 2 rate cuts. The Federal Reserve's dots plot is calling for 3 rate cuts, and higher for longer when it comes to interest rates is actually quite positive for the banks, because what you're likely to see is that the banks are going to be able to report stronger net interest income. So we're looking for this inflection, if you will, in net interest income, which we think starts to materialize in the second quarter of this year. So the momentum, we think, based upon what we're going to hear this Friday, as you pointed out, with some of the biggest banks, I think you're going to see a pickup in the momentum in this growth of top-line revenue.
Gerard, when you're talking to your clients, I'm curious, and they ask you, what's the one big risk for the banks? What do you tell them?
It's a really good question, because credit risk has always been one of the biggest risks for the banking sector. Last year, as you know, we saw 3 banks fail, and they didn't fail from the traditional reasons of credit risk. They failed because of liquidity risk. But the real risk to any bank is bad credit. And so when we look at that topic, aside from the net interest income inflection, which is definitely going to be discussed on the calls this quarter, the other big topic will be credit quality and the direction of credit quality. We're all very aware of what's going on in the office space, particularly the Class B and Class C space in our major urban markets, where vacancies in some of that space is as high as 50 or 60%. And then those properties' values have declined off of peak levels upwards to 75, 80%. But Class A properties, it's nothing like that. And so I think what you're going to find is more investors are going to realize that the U.S. banking industry, its exposure, particularly amongst the top 20 banks, to the most troubled area for credit today, office, commercial real estate, is very limited. And it's nothing like what we saw in 1990, when it was truly a debacle for the banks.
So that seems like it'll be potentially positive news if the banks can sort of convince investors, right, that is the case. I'm curious if we're going to get some upward revisions from these banks, raised forecasts, and if so, which are the most likely contenders?
It's really the point of the banks this year will be what you just mentioned, upward revisions, because last year, if you take a look at the estimates, ours included, the revisions throughout the year because of lower net interest income growth for most banks, not all of them, JP Morgan is an exception, but primarily due to lower net interest income and higher provision for credit losses, most estimates came down throughout 2023. And now, if the U.S. economy is truly on a growth path this year of 2 to 2.5%, as Ed Yardini mentioned in a prior segment here, I would suggest that the upward revisions this year could come from 2 areas. One, the banks last year, because of the new accounting for loan loss reserves called CECL, current expected credit losses, the CECL accounting built up reserves in 2023 for the likelihood of a recession. And that doesn't seem to be the case now. So there could be, believe it or not, this year, some reserve releasing due to the resiliency in the economy. Now, nobody pays up for those earnings. We understand that. But it builds up capital, which means stronger buybacks. The other area of potential upward revisions is what we just discussed, which is that the Fed cuts once or twice this year. and the bank's net interest income inflects stronger than expected, then you're going to see higher earnings estimates as well. And as you guys know, upward revisions in earnings estimates generally is a favorable trend for stock prices.
And Gerard, let's get into some specific names here as we head into earnings season. What's your top pick, Gerard?
I would say that going into the earnings season, we have both a money center pick, which doesn't report on Friday, which of course is Bank America. They report the following Tuesday. But also, we would say that JP Morgan is a perennial favorite. It's done very, very well. It's owned by just about everybody around the world, but Bank America would be the favorite pick in the quarter. And then for a regional name, there's two of them, Fifth Third and KeyCorp, both based out, of course, out of Ohio. KeyCorp has the big derivatives book and Treasury portfolio that will reprice this year. And Fifth Third is just a basic blocking and tackling, grinding out steady growth led by their consumer banking and consumer deposit business, which is especially down in the Southeast, which is quite positive.
Gerard, how is mortgage lending going for some, particularly for some of those super regionals?
It's interesting because residential mortgage lending, that business has been pretty much pushed out of the banking industry. You look at the top 10 residential mortgage originators in the United States, and about half of them, or 6 out of the 10, aren't even commercial banks. They're mortgage brokers or mortgage banks, if you will. And so Rocket Mortgage, of course, is one that I think everybody's familiar with. And so when it comes to the residential mortgage business, it's important for some of the banks, but what really drives the regional banking growth, and I'm glad you brought this up because another possible positive that the long-only community is looking for is better loan growth. Loan growth is tied to nominal GDP growth. So if we get 2 to 2.5% real growth this year, nominal growth comes in closer to 4 to 5 or 5 to 6%. That bodes well for loan growth. When on the regional side, the real backbone of their loan portfolios is commercial and industrial lending, C&I lending, as it's called. And that's what will be driving the growth more so than residential mortgage lending.
And finally, Gerard, I'm interested why you're on the sidelines here when it comes to Goldman and Morgan Stanley. And what would you need to see, Gerard, before getting more bullish?
Yeah, it's really comes down to the investment banking business swinging back into some real growth. As you know, we had a phenomenal 2020 and 2021 in investment banking. 22 investment banking was depressed. 23 it came back somewhat. First quarter is improved. Now, trading activity is kind of interesting because there's a yin and a yang. You want volatility for trading activity to pick up. Sadly, when Russia invaded Ukraine in the first quarter of 22, the trading activity was very strong. That has, of course, died down with volatility dying down, even though there's a lot of uncertainty out there, particularly in the Middle East and Ukraine, Russia. But we really need to see the Fed, pause and be finished with raising rates. Once the market's convinced of that and investment banking numbers come back stronger, I think the investment banks will benefit from a much stronger investment banking business, which there's a lot of stuff in the pipeline. The quote green shoots are out there. They just haven't really flourished just yet.
Gerard, always love having you on the show. Thanks so much for joining us.
You're very welcome. Thank you.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.
There's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickry to get you up to speed on the action from today's trade. So let's start with the major averages here. Down by about 9 points for the Dow, so up off the lows of the session here, nearly unchanged going into tomorrow morning CPI report, which is going to be the next big trading event. The S&P 500 very slightly higher on the day, just ticking higher in the last few minutes of trading here, but not even up 0.2%. And the Nasdaq up about 1/3 of 1%. It also ticking up here towards the end of the session. Looking at some of the other asset classes we're watching that are pertinent to what's going on for stocks as well. We had 10-year yields actually falling today, but that not really giving a meaningful boost to stocks, but down 6 basis points to 4.37%. We also continue to watch what goes on in the oil market. Crude oil futures continuing to pull back. Interesting, though, that this, too, did not give a big lift to stocks, but oil trading below $86 a barrel. Jared?
Yeah, it was interesting to see the last hour of trading. We got this ramp. It was actually right about the time that Jennifer Schonberger started interviewing Raphael Bostic. Is there a connection? Probably not, but I didn't see anything else on the tape. So behind me, you see real estate in the upper left. That is the #1 sector today, up 1.3%, followed by utilities. So the two interest rate sensitive sectors up the most, and I'll throw tech in there. Tech is also interest rate sensitive, but then you have staples, consumer discretionary, and healthcare. Only financials and industrials here closed the day in the red. And just looking at some of the leaders here, solar was a big winner. TAN, that ETF up 4%. Chinese internet also doing pretty well today, up 1.5%. To the downside, though, crypto and cannabis, those two fringe stocks or fringe areas of investment, both down about 3% today. Josh.
Stocks fighting for gains heading into the close here, finishing the day well off the lows of the session. Madison Mills is here with the takeaways from the trading day. Madison.
Hey guys, well, seeing a lot of these stories that I had selected from earlier today changing up a little bit here, so that's always fun when you walk on set. I was thinking that we were going to see a big rally in the chip space because of some news this morning from Google announcing that they have new AI chips that could be utilized in their data centers. Using these AI chips, they're going to announce an ARM-based central processor. We are seeing movement in Alphabet, but that is not enough to feed through to the overall IT sector, and we're not seeing that necessarily translating to gains across the major indices because we are seeing a sell-off in some of the other names that I would have anticipated would have been up on this news. The #1 trending ticker on the Yahoo Finance platform right now, NVIDIA, down over 2% today, perhaps seeing traders taking a little bit of profit before CPI, not necessarily sure what that's about, but still seeing the Philadelphia Semiconductor Index up on the day over 1%. So watching what's happening in the chip space, Julie, you had mentioned that we're not seeing much of a lift given to stocks, even though bonds are up and yields are down, falling 6 basis points to 4.36 this afternoon on the 10-year. So 4.5% is going to be the big next test for the 10-year moving forward. We are seeing this volatility in the bond space, potentially an indication to me that we're not sure yet what we're thinking in terms of Fed rate cuts and when that's going to come. So I'm curious to see.
Yeah, we didn't get any clarity from Bostic a little while ago either in a conversation with our Jennifer Schonberger when pressed on his comment or his dot, if you will, in the fourth quarter of the year, seeing a cut. She said, well, could we see no cuts? Could we see more cuts? And he said, I'm going to summarize. Meh, I don't know.
Risks are balanced.
The risks are balanced to my outlook.
Yeah.
And that continues, I mean, that feels very parody of what we hear from Jay Powell as a big meh as well. We're data dependent, but what if the data isn't giving you a central thesis to ride on? What does that even mean moving forward? That's interesting though, given, didn't he just say one cut probably?
He did, and I think that's still his base
yeah.
case, but she sort of said, are the risks more tilted to none or to more? And he said they are balanced.
He said meh.
Between, effectively, I don't know, is effectively what he said. So, but it seems like that the market, too, to your point, also doesn't know, right? But that stocks are willing mostly to rally even given that there is not that precise knowledge.
Well, this is a question I've been repeating to a lot of our guests in the morning show is what matters more this week, inflation data or the start of earnings? Because we keep saying that the Fed matters so much, and of course they do, whatever. But if we have earnings growth, isn't this market kind of willing to look past any of the scary signs in the macro data to just continue to rally off of that momentum? Because why would you not? And then we have Chris Harvey raising his price target and saying valuations don't matter anymore. So why would you worry too much about higher for longer if, valuations can go as high as possible and nobody cares?
I think, was that kind of Dr. Ed's point to us? We asked him whether no cuts this year, would that be a problem for the market? And he seemed to suggest it's really the focus is on economy and profits.
Yeah. And he said because earnings are going to hold up relatively well. That said, he is still keeping valuations in a corner of his mind. That's why he hasn't increased his price target beyond 5,400 for the year, but he seemed pretty optimistic because of the earnings outlook.
I thought it was interesting. We asked him what is one big risk when Dr. Ed's talking to clients. I thought it was interesting. He mentioned geopolitics front and center.
Because of oil,
right?
Specifically.
And kind of rising tensions between Israel and Iran. And that was kind of the one big bogey he had out there and what it would mean for the oil market.
And I wonder to what extent we're going to hear from the Fed about the run through of commodities to inflation, because that's not something that they can really control with higher rates. And also it's not necessarily part of what they look at when they strip out energy and shelter. But if Americans are feeling a pricier pump, what does that do to consumer sentiment? What does that do to the feeling about inflation?
Yeah, what does it do to inflation expectations and their willingness to pay more?
Right.
So, yeah, there's a lot of
questions, Madison.
A lot of questions out there. Can't wait for CPI tomorrow to answer them all for us.
All right, thank you. Appreciate it, Maddie.
Thanks.
Moving on, time for one of today's trending tickers. Let's take a look at shares of NVIDIA following today's trade. The stock closed at $8.53, entering correction territory here. So slipping today's trade, a bit of red there, Julie. Remember, the company did host that developer conference last month. Unveiled that new line of so-called Blackwell chips. Investors cheered that. Since that event, the stock has dipped a bit. Though, of course, listen, pull back the chart. It's still just a monster. It's up about 70% so far this year. Why the dip today? Our buddy Steve Sosnick offers one theory, strategist, of course, from Interactive Brokers, saying taxes. That many investors had a good 2023. Obviously, the taxes for those profits coming due, he points out. So maybe no surprise, Steve says, if fully invested individuals are selling to raise some cash now.
I mean, I guess you could also, if you wanted to make a fundamental case for why it pulled back a little bit today, you could look at the chip news that we got.
Intel.
You got Intel, you got Google, even though Google's not making GPUs, it's making CPUs, so not competing directly with NVIDIA, but nonetheless, there is going to be competition at some point in this space. Although most of the people we talk to say NVIDIA is so far ahead, it will be fine, and it's not a zero-sum game, that there's going to be enough demand to go around. I just want to confirm, indeed, we did see NVIDIA enter correction today. Your point is well taken. The thing is still a monster, but it is now down 10.7% from its close just on March 25th. So it has been a fairly rapid move downward as well. And as we also know, NVIDIA reports later than the other chip makers. So it's not due to report until later in May. And so we went through this last time where we heard from all the others, and then we had to wait for NVIDIA to figure out if it was going to confirm the recent move. So, we'll see if it continues to sort of fade into that period of time.
Yeah, it does. It's hard to pin it on news today because the competition question is, you can have these folks kind of gunning for NVIDIA, and they will be, like the Intels and the AMDs, but at this point, it's not just they're so far ahead, it's that what they've created is this ecosystem at this point, chips, hardware, software, which is going to be tough to beat.
I agree. It was just sort of devil's advocate.
Yeah, why not? Well, you got to do that, Julie.
You got to do it. Yeah. Exactly. All right, let's talk about another stock that we watched today, Tilray Brands. Revenue growing 30% last quarter, driven not only by cannabis sales, but beverage alcohol sales as well. The shares, however, did fall in the session on the company's lowered forecast for cash flow. Here's what Tilray Chairman and CEO Irwin Simon had to say on the company's growth momentum.
So number one, with the acquisition of the 8 ABI brands, that's where, most of the growth came from. Also, we've had a lot of new innovation that's just starting to get into the market. And at the same time, really focusing on these brands with new distribution. But we suffered from dry January, somewhat a dry February, which is a real phenomenon out there. And it's something to overcome. And that's where, as we've introduced not alc beers, we've introduced some energy drinks, we're introducing some, sparkling water products, et cetera. So with that, as Tilray is such a diversified company today, and third quarter is actually one of our lower quarters, it's great to see some growth happening within our businesses and, across our sectors.
I do want to address, though, the reaction that we're seeing, Erwin, because it looks like even though you did see that growth in revenue, came in a little below estimates, loss was a little wider than estimates, and then there's that EBITDA, the cash flow forecast here. Where did these various shortfalls come from, do you think, and how's that going to also the trajectory look like for the next few quarters?
Listen, not everything happens as planned. And, we did our Hexo acquisition. We did our Trust acquisition. Integration sometimes takes longer than expected. Our first 2 quarters were not positive free cash. And, just from a timing standpoint, not able to make them up in our third and fourth quarter. We have announced the divestitures of some facilities in Canada, which ultimately will bring in additional cash, somewhere between $60 to $80 million. It also is accretive to EBITDA by about $5 million. At the same time, acquiring, the ABI brands, their margins are in the high 20s versus our legacy beer brands, which are in the high 40s. So there's a lot of contribution, a lot of cash that will come from that. So a lot of this is just a timing issue, Julie. And, as you're building, as you're growing, as you're getting distribution out there, not everything happens. And at the same time, as we're going through these businesses, we're looking at SKU rationalization, SKUs that don't make sense. As we're looking at simplifier in our product lines, our production, there's stuff we're taking in and out of the business here. So that's what it is. A lot of this is just timing. But I got to tell you, I really feel good where Tilray Brands is today and what's in Tilray Brands and the categories we're participating in and where we are from a global standpoint. And what could come. So if I sit here today and looked into a crystal ball, there's been so much chat over the last 4 years, what could happen with cannabis on legalization and rescheduling.
Right.
I believe something will happen. We're well positioned if medical cannabis is rescheduled from, a Schedule 1 to a Schedule 3. And we could easily jump in there with medical cannabis. We could export it from our Canadian operations. We, are a big medical cannabis seller in Canada, and we're probably number 1 in Europe. So we're ready to do that. In regards to
Erwin, I'm sorry, just to pause you there. I do want to ask a little bit more in detail about that because you have a market here in the United States where you already do have state-by-state dispensaries that are selling medical cannabis. So how would your approach be different than what we are seeing from the existing market players?
So if it was rescheduled, from a Schedule 2, from 1 to 3, and it's legal, from not being a narcotic anymore, do we have the opportunity to sell it into the U.S. and bring it in from our Canadian operations? With that, do we have the opportunity to acquire, a company here? Right now, we can't do anything in the U.S. because we're a Nasdaq listed company. So it would give us the opportunities, whether we do it on our own, we buy, and actually we own the debt within MedMen. Does it give us the opportunity to do something within MedMen? So we have optionality. Right now, Julie, we're not locked into, we're not an MSO. We're not locked into that state to be a producer, to be a distributor, to be a retailer, and we don't have those investments. So It gives us optionality with the change that could happen.
I also want to ask you about the change that happened in Germany, right, with the changing cannabis regulations there. And again, it doesn't sound like you would be able to enter the just regular consumption market there because that's more on a personal and club level basis. But on the medical level, how would things change with the latest law change there?
Listen, what happened, from a personal level is one thing that happened in Germany. The big opportunity for Tilray and the big opportunity is what happened on the medical. Prior to this year, only a certain amount of doctors that were licensed could prescribe medical cannabis. Now every doctor in the country can prescribe medical cannabis. And with that, it just opens up the market for, a tremendous market size. Number two, we have a facility in Germany today, and that facility before only was selling to the German government under a tender. With that, this facility now can sell to, any pharmacy and can sell to anybody that wants medical cannabis in Germany. Secondly, is we have a large grow and producing facility in Portugal that can sell it into Germany. So we already have people on the ground, we have grow on the ground, and we have brands in that marketplace that can really, make a big difference. The other thing in Germany, we have something called Tilray Pharma, which was CC Pharma, which is a medical distribution business that sells into 13 drugstores. So we're vertically integrated to get the product to drugstores to be able to fulfill consumers, medical cannabis prescriptions.
Well, we'll stay in touch as all of these changes kind of filter through the system. And I know there's some changes being talked about in Canada to reform the tax system as well. But we'll leave it there. We'll talk about that next time.
That would be major. And that's a lot to talk about, too.
It is. Okay, so let me just squeeze one last one in. How confident are you that there will be those changes in Canada?
Listen, I'm, again, when it comes to predicting politics, I would never want to take a bet on that. But what I will tell you is this here. Something has to happen in the Canadian market. With price compression going on and a lot of the LPs going out of business, and I'd like a strong market in Canada, I think something will happen in regards to tax reform. For Tilray, it's about $80 million. Do I expect $80 million coming into our coffers? No. But do I expect something to happen? Yes.
Gotcha. All right. Well, stay tuned then, and we'll talk again soon. Erwin Simon of Tilray, thank you so much.
Nice seeing you. Thank you.
You too. Thanks.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
Pfizer's phase 3 study of its RSV vaccine showing promising results for adults under the age of 60. Here with the details is Yahoo Finance's Anjali Kamlani. Anj.
Hey guys, yep, no surprise here with Pfizer getting the positive phase 3 results for adults ages 18 through 59. That already adds to the body of knowledge that is with its a vaccine that is already approved for ages 60 and older, as well as the maternal population, so pregnant mothers who have been taking this vaccine later on in the weeks of pregnancy. So really good news for Pfizer. It's something that the investors have been waiting for because it really expands who Pfizer can cater to. Right now, they're the only ones on the market with that maternal vaccine, so approved for pregnant women as well as for 60 and older, but they do have some competition nipping at their heels. GSK was the first out the door with 60 and older. Meanwhile, Moderna also in some later phase trials for ages 60 and older, as well as a pediatric population. So Pfizer is quite ahead of the game in that respect. So good for them. And this, if the FDA does approve this, does mean that Pfizer would have a really strong market share.
Well, but how big is the market? I mean, my understanding was always that you didn't need to get this thing unless you were over 60 or a child. Is it just other at-risk adults, and how big a market really is that?
Yes, it is just those who are immunocompromised, those who are likely to get it. So while it isn't necessarily as large a market, it does give them really good footing when it comes to the broader RSV market. They can have different different populations for it, and they do have a focus on the younger. That pediatric population is really the one that still needs catering to. So it's interesting that no one has been able to really corner that part of the market just yet, because that is where we've seen the highest number of illnesses throughout the throughout the respiratory virus season, and that's where the focus is. But meanwhile, they do have basically everything else under the umbrella covered here.
Interesting. All right, thanks, Anj. Appreciate it. Well, let's talk about shares of Lucid. They got a boost after beating first quarter delivery estimates. Yahoo Finance's Pras Subramanian here with the latest. I feel like we have now this collection of the high-end EV makers that are troubled in one way or another to differing degrees. So this is some welcome good news for Lucid investors, right?
Yeah. A record amount of deliveries here, 1,967 units delivered, beating estimates of 1,850. So it's a nice little beat there. Interesting, the production was down to 1,728 or so. So that was really interesting. They produced less than they delivered, but maybe had some back orders and things like that. So a boost here for the stock, little one at the moment here. But still some issues like you mentioned, right? So this is still a car, the Lucid Air, that's not a high volume car. It's an expensive car, sedan. On the luxury end of things, you're never going to get above 2,000, right? That's gonna be rare for them, at least in this country. It's going to be hard. So until you can get that volume play up, how do you, handle the immense startup costs that they entail, right? With the factory in Casa Grande, they're making a new factory in Saudi Arabia. Those are huge fixed costs that they have to sort of defray at some point, and that the SUV, the Gravity SUV that's going to come out at the end of the year, that can't come out soon enough for them.
All right, let's switch gears. Talk about watches that I can't afford. Rolex making some news today.
Yeah, let's stick with the luxury beat here, right? So Rolex, Watches and Wonders, the big sort of trade show in Geneva. Rolex get the marquee spot the opening day. They get their big debut here, a bunch of new watches here. A little bit subdued in a sense that they went from last year was all the hype watches, the emoji watch, the watch with the emoji signs that pop up depending on the day of the week. Now they're more traditional. You got the new GMT. You got an updated deep sea diving watch, all gold, and also a very expensive Daytona, like you mentioned, Josh, a watch that I can't afford either.
The big thing here is that beautiful, though.
The big thing here is that for Rolex, the watch industry, at least the Swiss watch industry, is kind of coming off recent highs here. Imports are down. Rolex, you still can't buy one in stores, but the question is, how long is that going to last? They want to boost production. They want to boost. They bought Bucher and Tourneau operators to get more of a retail presence. Will we see more watches in stores? We'll see, but I think the secondary market will be happy to see some of these watches.
How much correlation is there with the broader luxury market? Because we've seen some bumpiness from some of the large luxury companies as of late. Does this track pretty closely to that, or watches like their own thing?
You know, the Rolex's CEO spoke about this yesterday from the actual trade show about how the smaller brands are more sort of susceptible to the bigger shifts in the industry from higher rates, things like that. Rolex too is not immune from these things, but to a lesser extent, they have more of a well-known brand name. People want to be associated with them. They want to buy their watches, but yeah, you mentioned geopolitics. Things like that do affect you. Well, I should buy a $15,000 watch. Things are kind of iffy right now in the world.
To go diving, an all gold watch for deep sea diving.
That apparently weighs over half a pound.
Yeah, that's a lot of gold.
Well, and you want to be buoyant when you're down there, don't
Maybe
you?
you need another weight.
I mean, I've never been deep sea diving, but who are you impressing down there?
The important point is you're looking good as you're going, Julie.
As
you're
you're
sinking,
going for
you're
the
looking
octopi
great. Yes.
and the other deep sea creatures.
Ulysses, mermaids, things like that.
Sure.
Yeah.
You're right. Froz, thank you. Appreciate it. Time now for What to Watch Wednesday, April 10th, starting off with the economy, the inflation report that Wall Street's waiting for, the March CPI report coming out ahead of the open. Economists expecting CPI to rise by 0.3% from the previous month. And on a year-over-year basis, CPI expected to rise 3.4%. Report providing another piece of the economic puzzle as Wall Street looks for more clues about when the Fed could cut rates.
And speaking of the Fed, after tomorrow's CPI report comes out, we'll be getting more commentary from the Fed. Fed Governor Michelle Bowman speaking in the morning, Chicago Fed President Austin Goolsbee in the afternoon. And this comes after Atlanta President Raphael Bostic told our own Jennifer Schonberger earlier that his base case is still one rate cut this year. The Fed is also releasing its minutes for the March FOMC meeting, giving us more insight on the monetary policy stances of each of the committee members.
And finally, on the earnings front, Delta Airlines and Rent the Runway both reporting tomorrow. Delta reporting first quarter earnings for 2024. In the morning, one analyst showing that rising wages, including for pilots, could weigh on margins for the airline.
All right, and that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell. We've got more Yahoo Finance, though, on the other side.
Moody's releasing a new report highlighting that office vacancies are hitting an all-time high. One of the authors of that report expecting that things are going to get worse before they get better. We have that author here for more, Thomas LaSalvia, head of commercial real estate economics at Moody's. Thomas, it is good to have you on the show. So maybe just start high level, Thomas. What do office vacancies look like right now across the country? We see different reports, Thomas, but what's your read?
Yeah, thanks for having me. Currently, we're sitting at 19.8% vacant at the national level. Now, this is a record high. The previous record was set in the late 80s, early 90s, which was a combination of a run-up in new supply along with the savings and loan crisis. That rate hit 19.3%, 19.8%, and as you said, it's likely going higher.
So, Thomas, what are the implications of all of this? This is something we've been struggling with, right? Because we knew the vacancy rate was high, although 19.8% is pretty darn high. You know, who owns that real estate? Who owns the debt? We've been waiting for this sort of CRE cascade for a while. It hasn't arrived, at least not to the magnitude, but does this imply it's still coming?
That may be going a step too far. Are we going to continue to see more and more stress for rents and occupancy levels? Yeah. In fact, I think effective rents, so including concessions, they're going to likely come down a bit more. The vacancy rate is likely to peak above 20% and probably sit there for a few years. And I think that's the key, is that we're still in this slow bleed period when it comes to the income being produced by a lot of these office properties. So when you talk about stress on the debt side or the equity side, well, it's all about the mathematics of, do you have enough income still coming in and likely to come in over the next few years to be able to kick the can until we get to maybe a lower interest rate environment and refinancing can actually occur at levels that make sense for banks and other lenders out there.
And Thomas, I'm interested when we talk about this trend of office vacancies across the country. You know, we talk about them nationally, but are there regional differences to call out?
Yeah, I think that's fair, right? We look at these headline numbers and it's easy to sensationalize and think all locations, all properties are really in rough shape, when that's not particularly the case, right? Right now, we're in a period, I think more than ever, where employers are following their most valuable input to production, which is talent. And so as talent has migrated towards more affordable locations across this country, we've actually seen a bit of a dispersion of where office firms want to or need to locate. So we're seeing places like Nashville and Tampa and Omaha, Kansas City, places that never really were primary office markets, start to pick up a little bit of momentum. And the key to all of this, though, going forward, and I'm not about to put New York, San Francisco, Chicago, Boston to bed, right? There's still going to be a lot of value there. But I think the key to all of this going forward is really affordability and critical mass. If that particular metropolitan area, region, can maintain housing that is comfortable, safe, a decent size for the middle class, then you're going to continue to get more of these affordability moves. And I think you're going to continue to get more office firms moving into those locations. And that actually creates a bit of a virtuous cycle. And we've seen that in places like Dallas, which have a strong finance culture, corporate headquarters, but now they're growing with some advanced manufacturing, tech, and you're seeing that virtuous cycle because they are able to maintain affordability across that metropolitan area.
So, Thomas, going back to the idea that we're at 19.8%, it is likely to go higher before it comes lower. I'm curious how high you think the vacancy rate could go, and then what is a normal rate, and is it ever going to get back to where it was pre-pandemic?
Yeah, that second question, I think, is the key question, because do we see vacancy rates inching up a bit more before supply and demand get into a new equilibrium? Yes, absolutely. Maybe another 50, 100 basis points. Will we remain above 20% for a while? That's a very good chance that that's going to happen too. But then on the backside of that, where is that new, what we might call natural rate of vacancy? Right? A lot of people are talking about this with interest rates right now. Is the new neutral rate of interest higher than it was before? But I think we could say the same thing with the new natural rate or equilibrium rate of vacancy when it comes to office. The way we're looking at it is a good 10 to 20% of office buildings are probably obsolete going forward. Right? That's a pretty big number. And so you layer that on top of the traditional frictional unemployment and business cycle, not unemployment, but vacancy rates, you're going to end up with more of a long run or natural vacancy rate in office of 15, 16, 17%. I don't think that's out of the question. And little by little, what you'll see is the same thing you've been seeing in regional malls over the past 20, 25 years, which is many of those coming offline, being repurposed, being raised, turning into something brand new if that land is still valuable.
And Thomas, I'm curious, as you sort of try to gauge and track the health of the market, Thomas, what exactly do you track? What is it? Small regional banks, asset sales, transactions? I'm just curious with the metrics you follow closely, Thomas.
Yeah, well, there's the metrics we're talking about a lot right now, which is the space market side of the equation, the income coming in, being generated by the tenants of those buildings, so rent and vacancy. And then you go to the capital market side, and we look very, very closely at sales transaction data. We're looking at what types of loans are actually being made. What are the terms of those loans being made? Is the math starting to work for certain properties in certain locations, right? Is there more equity being infused by maybe certain investors that haven't been, say, part or at least a big part of the real estate industry in the past? And so all of that, particularly when it comes to office, I think is in flux right now. And that's what we're gauging. That's what we're looking deeply into at Moody's CRE to try to make sure we're ahead of the curve, to make sure that we're actually finding the lead indicators that show us when things will start to normalize within office. But we are still a ways away from that.
Thomas, thank you so much for joining the show. Appreciate it.
My pleasure. Thank you for having me.
Yahoo Finance is taking a deeper look into the history of Amazon. From an online bookstore to one of the most dominant companies in the world, we go behind the ticker into the tech giant.
From its start as an online bookstore to its rise in e-commerce and cloud computing, Amazon has become one of the world's most iconic brands. In 2023, the tech juggernaut generated over $575 billion in revenue and boasted more than 200 million Amazon Prime members worldwide. Beyond the Ticker takes a deep dive into some of the company's biggest moments. Amazon was founded in 1994 by Jeff Bezos in his garage in Bellevue, Washington. The company was originally conceived as an online bookstore designed to compete with Barnes & Noble. On May 15, 1997, Amazon went public via IPO at $18 per share. 1 year later, the company began selling CDs, marking the start of its effort to become a shopping Goliath. In 2005, Amazon launched Amazon Prime, a $79 per year membership with free 2-day shipping on eligible orders. A year later, Amazon launched Amazon Web Services. The platform would go on to become the top cloud computing service ahead of those from rivals Microsoft and Google, and one of Amazon's most successful businesses. In 2011, Amazon rebranded its video service as Amazon Instant Video, with access to 5,000 movies and TV shows for Prime members. 3 years later, Amazon acquired the video game streaming website Twitch for $970 million. Amazon then acquired high-end supermarket chain Whole Foods in 2017 for $13.7 billion. It has since integrated the two companies, offering discounts for Prime members. On September 4, 2018, Amazon became just the second U.S. company ever to reach a $1 trillion market cap after Apple reached it earlier in the year. Amazon sales and profits surged during the COVID-19 pandemic in 2020 as consumers turned to online shopping. In 2021, Bezos announced that he would step down from his role as CEO and be succeeded by AWS CEO Andy Jassy. In 2024, Amazon was added to the Dow Jones Industrial Average, replacing drugstore giant Walgreens. The company continues to evolve, investing billions in AI startup Anthropic, developing more smart home products, and launching an AI shopping assistant named Rufus. It's safe to say Amazon is a staple of the digital age.
The fight for user attention on social media is heating up. TikTok users posting screenshots online of a notification regarding a new app from TikTok, one that can potentially rival Meta's Instagram. Here to discuss is the CEO of Double Verify, Mark Zagorski. Mark, it's great to see you. It's not a new thing to see social media platforms sort of copying each other, but TikTok has been sort of a one-trick pony. a very good trick in the eyes of most users, but a one-trick pony nonetheless. I mean, how big a deal would this be if it was doing a photo service in addition to its video posting service?
I think it's a pretty big deal. We've seen this before, as you noted. When these social platforms have really heavily engaged audiences that are captive audiences, they're going to look to monetize them every way they possibly can. And, this was exemplified earlier when we saw, for example, Facebook launching Threads, an X competitor. We've seen, platforms like Amazon, for example, start pushing Prime and ads across Prime. So it's just an example of a monetization play of a really attractive demo that continues to grow and is super engaged.
Do we know, Mark, what the appetite right now is among marketers for TikTok and whether there's been any kind of shift there or change, Mark, given what we're seeing on Capitol Hill?
So we work with TikTok on the brand safety front, and we've been doing that for the last few years, helping ensure advertiser spend is measured and brand safety violations flagged. We have not seen any slowdown in spend across TikTok. I think, the current, political environment notwithstanding, advertisers know it's a really solid platform to engage users. We've seen the demos get better across that platform over time, moving from kids and teens to now a lot of the politicians who are even talking against TikTok are still on the platform and still, shilling, for lack of a better term. So, we've not seen ad spend move. Now, obviously, if something should happen in DC, those dollars would change. But TikTok's a big platform. U.S. is a big market for them, but they're all around the world.
I'm curious, because this is not the first time we've had this discussion about TikTok at least being divested, right? We had that discussion a few years ago. Are advertisers owner agnostic? In other words, did you see them? Because it seemed like it was getting closer last round around than it has yet this time. Do advertisers tend to make changes or contingency plans in advance of those kinds of potential events?
The digital world is one which is pretty agile. So dollars can move pretty seamlessly from platform to platform pretty quickly. So advertisers become relatively reactive when things happen. Now, with regard to ownership changes, really, I think, the advertisers will look to see, is the engagement level still the same? Is it an environment in which their brands can be safe? And is it one where they can kind of establish their global footprint? And, if that still remains, I think TikTok still remains a viable entity for advertisers, no matter who owns it.
Mark, also just more broadly, interested to get your take on just kind of the overall digital ad market right now, how healthy and resilient it looks to you, Mark. I would think this would be a good year, just given, the Olympics and the election, right?
Yeah, you've got a lot of outside forces, right, they're providing tailwinds. You mentioned Olympics and the elections, which certainly push more dollars in. We're going to have probably the heaviest digital spending election in the history of the world this year. And that's not just in the US, this is around the globe. So, digital ad spend is expected to grow, year over year. I do think that we are seeing the larger platforms take a lion's share of that growth. Particularly as they lean, more heavily into personalized experiences, engagement that draws users in, and then create a safer environment than maybe that's been there in the past.
Mark, it's great to see you. Thanks for joining us.
Absolutely. Thanks for having me.
Coming up, consumers are now preferring comfort over appearance in their footwear. That's at least according to one survey, putting once stale brands into the spotlight. We'll tell you which after the break.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
When was the last time you wore a pair of Uggs or Crocs? Well, if you have, you're not alone, as consumers are now preferring comfort over appearance. Brooke DePalma is here with the details. Brooke.
Good afternoon, Josh. Good afternoon, Julie. I mean, consumers' desire to be comfy all day is putting one stale brands into the spotlight. So think Uggs to work, think Crocs to parties, and maybe even Birkenstocks lately have made an appearance during the colder months with their hit shoe. You can see right here, the Boston Clog. Now, last year in 2023, the global comfort footwear market reached $26 billion, and the desire to be comfy is slowly expected to grow. You can see here by 2028, the data platform Research and Markets expects it to surpass $47 billion. And now get this, Americans only buy about 7 pairs of shoes a year, according to Stifel analyst Jim Duffy. So top footwear brands like Adidas and Nike, well, they may want to watch their tails here, as these smaller companies could get a lot bigger. In the comfy shoe market, those that are gaining traction include Decker brands with growth from the brand UGG and those Hoka sneakers. Now, Crocs is also in focus with innovation and personalization with those gibbet charms, and Birkenstock, the OG comfy shoe, as well as Skechers. Now, UB analyst Jay Soul said that all 4 of these brands are, quote, really well positioned to continue to deliver nice growth, adding that their stocks could face ongoing pressure if consumer strength changes. Now, this trend has been growing for quite some time. And if you take a look at this, Crocs revenue growth, we were seeing growth pre-pandemic, but it more than tripled with 2023 revenue coming in at $3.96 billion. Now, why is that? Well, consumers who tried Crocs during the pandemic around here actually decided that they're going to now wear them in public, as dress codes for kids in the office are way more relaxed than what they used to be. Now, 2 brands that might have missed out on this trend, VF Corporation brand Vans, as well as Allbird. Now, Wedbush analyst Tom Nikic said that they failed to introduce new products, that's as far as VF Corp's Vans go, and Allbirds, well, they struggled to gain customers because of a limited physical retail presence. Now, guys, all eyes are on the next generation. Think Gen Alpha and Gen Z. And in Piper Sandler's latest consumer survey with teens, Crocs actually fell from number 7 to number 6 here. And that's mainly due to the popularity of, get this, UGG. And Crocs were also ranked the 3rd brand that could be, quote, on the way out with male teens. So losing popularity there. And Josh, Julie, what I've learned most while doing this story and while writing about what some may consider to be ugly shoes is that there are a lot, guys, of hot takes in this newsroom. So many opinions while I was looking to write this story.
Well, I mean, you are a Birkenstocks guy, which I think are considered to be in this category. I have a big Hoka consumer at home.
Yeah.
So, like, I don't know.
See, I think breaking down
But
comfort
are you wearing
and appearance,
them more? Is this more of like a daily occurrence versus
I'm daily.
what it used to be?
I'm daily. See,
Daily,
the problem
every day.
comfort versus appearance. I mean, I happen to think the Birkenstock Boston is a comfortable, handsome
and
shoe.
good-looking shoe. I guess
good-looking.
beauty is in the eye of the beholder, I guess is
there you go.
the
That's the
bottom
lesson.
line. All right, thanks, Brooke. Appreciate it. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell. Have a good night.